Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. As dollar weakness persists, the EU and China are looking to seize the opportunity to boost the global use of their currencies.
Moments of change can also be moments of opportunity. The ongoing changes create the opening for a global euro moment.
We will discuss the de-dollarization push as President Trump's erratic trade policies turn investors against the king currency. PwC U.S. partner and chief economist Alexis Crow shares her insights in just a moment. Also ahead, we head live to Kuala Lumpur, where ASEAN countries, China and Gulf nations are boosting trade ties as they try to fend off U.S. tariff threats. Plus, the CFO of India's largest steelmaker joins us live with what he expects from a trade deal with Trump. You're with Insight. Now, Asian shares fluctuating as investors await fresh trade news. With the dollar front and center, take a look where we are in terms of the MSCI Asia-Pac Index, currently down about 0.1%. It is the dollar that's its front and center, currently down about 0.1%. 3 straight days of losses. It is at the lowest level since July 2023, while the greenback is around key levels against pretty much a host of currencies, including the euro. Investor demand for dollars fading amid jitters over tariffs and concern over the U.S. government's finances. Now, European and Chinese policymakers are looking to jump on the opportunity to expand the global footprint of their currencies, adding another layer of pressure on the dollar. ECB President Christine Lagarde says U.S. policy uncertainty is a chance to boost the euro's international role. She's laid out her game plan to set up what she calls a global moment for the common currency.
Today, I think there is a key difference compared with previous eras. With the euro as the world's second largest currency, there is another international currency alongside the dollar. Europe has many of the key ingredients for success, but they need to be brought together in order to reinforce the foundations. So action is in order.
Meanwhile, Bloomberg's learned that China's central bank is asking major lenders to raise the share of yuan they use when facilitating cross-border trade. According to the PwC, the proportion of cross-border yuan payments in global goods trade has reached 30%. ECB President Christine Lagarde speaking of a moment for the euro, with President Trump's trade tariffs rewriting the rulebook and volatility hammering the markets, dethroning the dollar is getting talked up. Let's get more with Alexis Crow, chief economist and partner at PwC US. Good to have you with us. Welcome to the city.
Thanks so much, Haslinda. Delighted to be here.
We've been talking about de-dollarization for a while now. Is this the moment of truth?
Well, it's very helpful and important to be able to break down the functions of money when we think about the dollar, because there's so many headlines smashing around. And if we think about the dollar as a unit of account, a medium of exchange, and a store of value. So on a unit of account and a medium of exchange, we have seen some different challenges to the dollar as of late that have been accelerating. So if, for example, if you're buying oil from Saudi Arabia and you're sitting in China, why would you go via the dollar? If you're buying phosphates from Morocco and you're sitting in Brazil, why would you go via the dollar? So if we think about some of these trade settlements and commodities, I think we will start to move toward a different landscape. The real question, I think, that's prompted by Madame Lagarde and others is around the dollar and its role as a store of value. We think about that as a reserve currency, right? And what could challenge its status? And remember that acronym TINO, there is no alternative. So as we just discussed, 59% of global reserves still held in US dollar. The only real currency that it gave way to was to the euro after the inception of the euro. RMB is still holding flat at 3%. What we forecast is just this lower, slower burn out of the dollar. And it's not only tariffs, but it's also the question of trust with regard to alliances that may prompt other central banks to reduce their holdings of the dollar over time.
So we're talking about a dent rather than dethroning of the dollar. But Madame Lagarde, as you said, talked about how this is the euro's moment. How does it seize that opportunity?
Well, we clearly see markets responding to this, right? Where there's the rare moment with the euro strengthening, German bond yield strengthening. I would also say the Swiss franc is yet another European currency that's really been benefiting.
And not to mention the yen.
Yeah, absolutely, absolutely. $57 billion of foreign investment coming into Japanese liquid markets in April. But really, I think for the euro, the question is, one thing we see is, yes, the rest of the world is getting on. I never thought I'd see the day when Starmer would be discussing, deeper ties with Macron on security. And so I think there are trends in this direction, obviously Germany removing the debt brake. One thing that we need to look for is, would Europe move closer toward fiscal union, right? Will we see the issuance of more common debt potentially to fund the energy transition, to fund energy security, to fund the redefensification of Europe? And these are things that I would think would further enshrine the euro's status.
So you talk about a slow burn for the dollar right now in excess of 50% in the basket. We're talking about decades in the making, correct? I mean, 10, 15 years from now, how might that look like in terms of diversification?
Depends on how the policy shifts go and how severe these policy shifts go. Something also that I think is prompting investors to de-dollarize is this concern about the fiscal deficit in the United States and the creditworthiness of the United States. And we've seen how some ratings agencies have responded to that. And so I think also we've seen the extent to which, maybe even Japan looks slightly better as a safe haven here.
So the euro is a possibility. How about the yuan? We know that today Bloomberg reported that the PwC is asking its major lenders to use more of the yuan in cross-border transactions, looking at 40% from currently 25%, bearing in mind that the internationalization of the yuan has been going for quite some time, and that hasn't really picked up the way it wants.
Let's look at the policy priority of Beijing, which on this internationalization of the RMB and really that push toward including it in the SDR basket, the IMF rebuffed that, reforms were implemented. It's really only held flat at 3% of global reserves. It's this question on the unit of account and the medium of exchange that I think the yuan can really gain precedence over other currencies, and that's largely due to China's position as a trading partner across the globe. If we think about the use of currency swaps, that China has been doing with a country like Argentina, that it could potentially do and escalate with Brazil. I would say that the RMB, just looking at settlement, I think is going to grow in status.
But increasingly, trade deals between China and Southeast Asian nations are being priced in the yuan. And might we see a more expedited use of the yuan than you're anticipating now on the back of the tariffs we're seeing imposed by the US?
Yeah, and I think we also need to think about the ties between the GCC and China here. We think about China having imported records amounts of oil leading up to the Liberation Day. And so, again, I think the settlement of commodities here is another interesting question as these capital ties also start to deepen.
What does China need to do to make the yuan more acceptable to the rest of the world? I mean, currently, its weak economy is in question. I mean, issues to do with property also in question, consumption also in question. It's not a good picture for internationalization of the currency.
Let's talk about the financial economy and then the real economy. And I think what's notable is, going back to the days of Li Keqiang, we had reforms implemented across mainland China to be able to clean up wealth management products, et cetera. And the opening of capital markets that we've seen. JVs have been, majority JVs have been announced between French lenders, also now even Qatari funds looking into mainland China as well. So I think the opening up of financial markets is one. This concern around the real economy is of course another. You hint at the housing market and consumption. I think those, the downturn in consumption sentiment and consumer sentiment is obviously very clearly tied to this downturn in the housing market. And that, I would say, has been giving some investors pause just on Chinese equities. You've also seen some buying up at a discount, potentially, in China clean tech and new economy. So that concern on the real economy, I think, will push some investors away. But I don't necessarily think that dents the potential for the internationalization of the RMB.
The PwC has kept the currency stable. That's good enough, right?
That's right.
And when you take a look at the dollar, Trump has always said he wants a weaker currency and he wants to bring manufacturing back home. If that strategy actually works, it is detrimental to the dollar, right? I mean, the fact that it'll be less dependent, it'll be more self-sufficient. And all it means that, you know, it'll be importing less, meaning that there'll be fewer dollars out there.
There's also some questions around, you know, what is the alternative? And there's the crypto landscape and some of the conspiracy theories around that. I mean, what I would argue is, irrespective of what the president wants, I would say that there are certain shifts that are happening on the domestic policy landscape beyond trade policy that are also giving investors cause for concern and pause for example, upping their allocations to the U.S. And this question around onshoring manufacturing capacity is one that I think even goes beyond the potential trajectory of the dollar, and there's just open questions as to whether or not the United States has the talent to be able to support this. Whether or not you're quoting trillions of dollars worth of investment, it's a very clear question as to whether or not we have the talent in high-tech manufacturing, in low-tech manufacturing, in the retail space as well.
So at the end of Trump's term, how might that picture look like in terms of manufacturing and the impact on the dollar?
I would say that I think you're probably looking at persistent structural weakness in the dollar due to some of these other policy shifts. With regard to the manufacturing outlook, I don't necessarily see that as potentially living up to some of the halcyon dreams that have been put forward.
What is interesting is that when people look at alternatives to the dollar, more of the alternatives are actually coming from Asia, right? We talk about the yuan, we talk about the yen. What's the possibility of the yen becoming more of a reserve currency?
Well, we'll see how the BOJ treats this as well, right? I mean, I think you know, yields having hit historic highs, right, on JGBs, and I think investors are still, again, maybe even viewing this as a safe haven. So, you know, it's not only the yen, it's also equities, I think, that have looked very, very attractive for foreign investors, even sitting where we are in Singapore. Obviously, some of the Japanese lenders are sitting here positioning to be able to garner high net worth family office capital into Japanese equity markets. So I think we're definitely long Japan. And
the issue of trust in a reserve currency suddenly is higher for the yen versus the yuan?
That's right. And I would say that, again, this question of alliances is going to be an interesting one. So Eichen Green at Berkeley has showed that if, you know, the purveyor of a defense alliance and a defense and security umbrella is likely to have its allies hold its currency as a reserve currency. So to the extent that Japan is starting to become a more kind of active trading partner in this part of the world may also justify a ramping up of the yen as a reserve.
And speaking of allies, the BRICS alliance is often talked about the BRICS common currency. And some say as much as they talk about it, it'll be at least a decade or two before they come close to providing that alternative. That's a fair assumption.
Yeah, I don't really see that emerging so much.
At all, then? It's not really a viable idea.
I haven't really seen that emerging so much. I mean, I think one thing that central bankers from some of those countries have put forward is whether or not you need a world of currencies when you start to move toward CBDCs and digital currencies. And so I think that's also a question that's being put forward. And I would say India and Brazil are front runners here with the participation of the retail banks to be able to advance this agenda.
For these nations, which is a more viable alternative currency? Would it be the yuan or the yen or the euro?
I would probably be holding, as if I was a reserve currency, I would probably be holding euro, yen, and Swiss franc. Yeah.
And the biggest risk for the currency market right now, what would that be?
I would say continued deepening of policy shifts on the domestic landscape in the United States. We also haven't talked about a potential for asset price correction. And I think if you start to see contraction of growth, potentially stagflation, you could see an asset price correction in the United States, which would, again, I think, undermine the strength of the dollar.
And what kind of asset price correction are we looking at?
Look, valuations are still very, very high. If you think about the beleaguered commercial real estate landscape, you've seen actually price increases in the retail and residential, some of the multifamily space, of double digits year on year. So we really haven't seen any major correction. And so if you saw sort of a correction in real estate markets, that could also pull into some instability in broader credit markets.
And U.S. assets as a whole still overpriced, despite you know, the sell down that we've seen so far.
Still overpriced because we came from such lofty highs, right? When you think about it, from the inauguration down.
What would it take for U.S. assets to actually get to the level that would reflect the state of the economy?
Well, let's see where the state of the economy moves, right? I mean, we saw the Q1 GDP data looking rather lackluster. We had the largest negative contraction that we've had from net exports. So what we've seen is retailers have largely absorbed and wholesalers have largely absorbed the cost increases from the initial waves of tariffs. I don't think that they can do that forever. It'll start to eat into margins, and so you start to see slower earnings growth. Again, potentially a technical recession this year for the United States. I think that could also prompt a correction in asset prices.
So we've gone from expectations of a recession to a stagflation environment in the U.S. What are the chances of that? Because increasingly, people like, Jamie Dimon say that that has to be priced in.
Absolutely. And again, as he's shared, markets have been far too complacent and are still far too complacent. It's probably because of that acronym of TINA, right? People are thinking there is no alternative to the U.S. dollar, and everyone's still talking about U.S. exceptionalism. Well, the Europeans have highlighted very clearly that it's not necessarily so exceptional if it's debt-fueled and fiscal stimulus-fueled. So I think looking to the United States, remember, a technical recession is just 2 consecutive quarters of slowing growth. So I think we could absolutely have that this year. As we've heard from Kashkari and others, rates will have to be kept high because of the concern and the outlook for inflation. And so that is, again, a situation that has not been priced in by
But that's not to say that the U.S. is not exceptional, right? I mean, if you take a look at the data so far, it's pretty resilient, and they're still strong enough despite what the market's saying about, preparing for an environment of stagflation.
Haslinda, something we've talked about with clients over the last few years is something we call the 3 interlinked I's when it comes to the U.S. economy: immigration, innovation, and infrastructure. If you think about the last piece, the extent to which the IRA, although perhaps not greatly named, but the IRA really drove a lot of capital into clean tech manufacturing in the U.S. and innovation here. And again, these interlinked policies and shifts around innovation and immigration. I have a concern that when you start to remove some of these, that the outperformance of the U.S. economy vis-a-vis other advanced economies really starts to wane.
Okay, Alexis, hang tight. Great views so far. PwC U.S. partner and chief economist Alexis Crow is sticking around. Well, we have plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Japanese shipping giant Mitsui OSK Lines says it is becoming relatively optimistic about the global trade situation. President and CEO Takeshi Hashimoto told us his firm is observing a strong bounce back in Chinese cargo movement as Washington and Beijing seek to de-escalate.
Almost every day, every week, the situation is changing. So as of today, I'm becoming relatively optimistic because that the most important issue was, of course, the tariff and the trade policies between the big countries like U.S., China, or U.S., EU, and it seems to me that still that lots of the bumpy situation is continuing, but at the end of the day, that the gradually that the situation will be stabilized. So compared to that, our estimation in early April, that today's sentiment is better, so that I'm relatively optimistic about the future the development of the global trade situation.
What about the situation when it comes to carrier orders from China?
China, the situation is very, very drastic. In April, we observed the dramatic decrease of the trade volume between China and the U.S. and quite big negative impact for our industry too. However, after the agreement between China and the U.S. In early May, now we are observing the quite strong bounce back of the cargo movement. Therefore, of course, that this is the relatively temporary agreement, and we should see that what will be will happen in coming 90 days. However, so far we are enjoying the very strong market situation in May. So I really hope that at the end of the day that this trade conflict can be settled down in a reasonably good way.
We have seen this trade conflict before, though, during the first Trump administration. Have you taken any lessons from that period that you can apply now?
Yeah, the first Trump administration, the situation was a bit similar at the very early stage of the Trump government. That there are lots of the confused situation, but gradually that we could manage to adjust ourselves to the new market circumstances, and tariff war itself also slowed down during the first administration of Mr. Trump. So I really hope that at the end of the day that everybody recognize that the necessity and importance to sustain the global economy and global trade, because it's a kind of the backbone of the people's life, and also the production of the industries or the supply chain. Therefore, that still a bit early to decide. However, as of today, I'm relatively optimistic, and focusing that what's going on between the trade talk between Europe and the U.S. For coming few weeks time.
And that was Mitsui OSK Line CEO Takeshi Hashimoto speaking to Bloomberg's The Asia Trade. And here's some more top global stories we're following. German Chancellor Friedrich Merz says Ukraine has been given permission to use weapons given by its allies to strike deep inside Russia. Ukrainian President Volodymyr Zelensky has long appealed for his authorization, which has gained traction with Russia's latest barrage of drone attacks and President Putin's refusal to engage in serious talks. The Kremlin has brushed aside criticism of its drone campaign, calling President Trump's latest comments an emotional reaction. Trump on Sunday said he was considering new sanctions and called Putin absolutely crazy for needlessly killing people with his escalating attacks. NATO Secretary General Mark Rutte says the alliance will look to adopt a higher defense spending target of 5%, meeting a demand from President Trump once seen as unrealistic. The proposal includes a 3.5% target for hard defense spending and another 1.5% for related outlays. The Dutch government has said that Trump plans to attend a NATO summit next month in The Hague. Well, coming up, the latest from the ASEAN summit, where China is making its pitch for stronger cooperation as member states face Trump's tariff threats. We go live to KL next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Premier Li Ka-ching, or rather Premier Li Qiang, is calling for stronger ties with Southeast Asia as he pitches China as a more reliable partner. Amid trade tensions with the US, Li has been mounting a charm offensive in meetings on the sidelines of the ASEAN summit in Kuala Lumpur. Bloomberg's Avril Hong is there and joins us now. Avril, what's the latest on the ground?
Yeah, Has, it's day 2 of this ASEAN summit, and the big event, as we've been discussing in the past days, still going to be the ASEAN GCC China summit, this trilateral meeting that's taking place for the first time. Now, when it comes to Li Qiang and what he's been saying about possible cooperation with GCC as well as ASEAN nations, he says China's really looking forward to that and that they are willing to make positive contributions to uphold the interests of the global south. So really a sign of the times here. Now, just to give you a sense of the commitment China has to this part of the world, it's actually sent a strong lineup. It's not just China's number 2, Premier Li Qiang, it's also the Chinese Commerce Minister Wang Wentao, as well as PBOC Governor Pang Gongsheng that are part of the entourage. But that being said, this is only the second time that we're seeing this ASEAN GCC summit, and we are also at this point seeing China, right, being brought into the mix of a trilat. So you gotta wonder, does this potentially make things a bit trickier when it comes to agenda setting and ultimately what can be achieved?
Well, that's right, and not to mention that Xi Jinping was just in the region as well. Now, Avril, you just spoke to the Malaysian Trade Minister. Tell us more about that.
That's right. I spoke to Malaysia's Investment, Trade and Industry Minister Zafrul Aziz, and the focus of our conversation was still about these ongoing U.S. tariff negotiations because Malaysia could see 24% tariffs, and the U.S. has also been quite clear in that the base rate being 10%, that seems to be non-negotiable. So the Malaysian minister did suggest that maybe zero tariffs are not quite possible and that any reduction in the tariff rate would be seen as a positive outcome. Take a listen.
For Malaysia, and I'm sure for many other countries, the goal is to not have tariff. For us, anything that can go below 24 or at least 10, the minimum that the US will go a bit good for our industries.
You see, Haas, it's really about this tariff rate, and if at the end of the reprieve for not just Malaysia but some of these other Southeast Asian nations, if they see higher tariffs than the likes of China, does this in a way reduce their export competitiveness? Remember, China has made it very clear to partner nations not to ink deals with Washington at Beijing's expense. So all this figuring into conversations here at the summit, Haas.
Avril, thank you so much for that. Bloomberg's Avril Hong in Kuala Lumpur. Also, a key focus for ASEAN nations is whether Trump tariffs might have spelled the end of the China Plus One strategy, which drove huge investments into the region. Let's discuss with PwC US partner and chief economist Alexis Crow, who is still with us. We talk about tapping China, making China a strategic partner. There's also that concern, though, in the same breath, China might be dumping its goods in this part of the world because it no longer has access to the U.S. market.
Well, I think there's concern about China's contribution to the fight on inflation, also looking across to Europe, and even I'm hearing that from Latin America as well. So perhaps this is the next cog in the growth model of China, and I think eventually we come to the moment where China is again still relying less on exports as a driver of GDP growth and more toward domestic consumption. We've seen that obviously from policy statements in Brazil. Coming out of Beijing. I would say that when we think about the position here, China still remains the largest trading partner with many countries, and it's not only China, it's also looking at Japan, right, as some of the largest infrastructure investors in some of these countries. And so there has been, and we can see this in data and survey data, there has been a repositioning on behalf of some ASEAN countries as to whether or not the United States is a reliable partner, not only in terms of economic and commercial policy, but also when it comes to defense and security policy.
But you got to wonder what it means for ASEAN economies if that dumping really happens. As it stands, I think in the last 5 years, China's exports to the region has increased something like more than 80%. And to the GCC, that has doubled. I mean, to have that amount of increase in exports and still, being accelerated by dumping, that's going to be detrimental to the economies here.
Well, I think you need to also look at then what is then exported out of the countries to a country like the United States. And obviously Vietnam was in the ire of the administration for that with the 90% slap on tariffs simply because of that China Plus One phenomenon. And so Remember, China has been an aggregator of regional trade surpluses, so it's taken in a lot of inputs, even from countries like South Korea and Japan, and then also exported these. And I think, following cheaper wages from the shores of mainland China down to ASEAN has been a perfect component of that. If we think about the ties between the GCC and mainland China, I would say that I'm seeing a lot of GCC countries look beyond this potential dumping of goods and looking more towards strategic ties. So really looking at Beijing as a large export market for commodities and liquid fuels, really looking at the GCC as a linchpin of global trade, right? 2/3 of the world's population lives within a 5-hour flight of Dubai. So I think you're starting to see, and it's evidenced in this ASEAN summit, that GCC countries are positioning and taking a longer view.
It is interesting. For most of our shows, we talk about weakness in China's economy, but in your notes, you talk about resilience in China's economy. Square that for us.
Sure. I mean, first we have to look at, if the government doesn't necessarily meet its growth target of around 5% of this year, and say it hovers around 4.5%, the economy is still growing. This is still growing so much faster, right, than when it was at double-digit growth. So the size of the economy is that much larger. What we've also seen is the consumer, although there's been this downturn in sentiment, the consumer is still sitting on the highest level of household savings rate in the world.
That's more than 40%.
And you have this phrase in Mandarin, Tang Ping, which is the consumer just lying flat. So the consumer knows how to hold dry powder. And we've seen a lot of the luxury retailers coming from Europe, be they French or Italian luxury retailers, say, we're going to bet long on mainland China. So even though they've had double-digit revenue declines from the mainland, they're also opening in the order of double-digit stores across mainland China. And so I think, again, if you look at the path of luxury retailers, it's really holding long. The other thing is that China's not only in the low-cost part of the clean tech revolution, it's moving up the quality curve. We've seen that with instant charging for BEVs, et cetera. And that, even though you don't see those cars in the United States, you're seeing them in Thailand, the Philippines, and Brazil, which are 3 of the largest importing markets for Chinese BEVs. So this, when the government is putting behind all of its R&D behind industrial production and even using fiscal policy to support that, I think you're going to come out with a very different economic outcome.
So how are you advising clients? How should they be positioned if they're looking at China for the long term? We talk about this great potential in certain sectors.
Well, interesting that you all reported this morning, of course, that you're looking at potential strengthening of ties between Europe and mainland China. And that's something that we saw in the wake of Trump 1.0 and the initial sparks of the trade war in 2018. So if you're a European company, you're probably looking at China as an opportunity. And we've seen that in financial services very clearly. If you're a U.S. bank, you're still potentially looking at a China for China strategy. If you're a U.S. retailer, some of the headwinds around brand nationalism have largely receded, and you're still looking at a China for China policy. I think the thing to counsel companies is also to say, mainland China is starting to look much more like an advanced economy when it comes to wealth and growth. And so therefore, where are you looking to other markets? And we mentioned ASEAN at the start. I mean, I think ASEAN may be down for the next 2 years, just given the uncertainty surrounding trade, but these are still some of the fastest growing economies in the world. So we've also guided clients just to continue to think about the growth continuum. And here I would include India as well.
The thing is, when you speak to someone like Carsten Block, he says the reason why he does not want to invest in China is because of the uncertainty in regulations, in policies. You may just wake up to a new policy, perhaps a reversal of what's been implemented. That is a huge risk for investors like him.
Depends what kind of asset classes you're looking at, right? If you're looking at liquid markets, we're still seeing a lot of sovereign wealth fund and institutional investors say, I'm long China new economy and I'll be in liquid markets, but real assets is a different question.
How do you hedge those risks in China?
Well, I think many investors are thinking how you hedge those risks in the United States these days as well. So again, I would just counsel wisdom on specific choices of asset classes.
Alexis, it's been a pleasure having you with us. PwC US partner and chief economist Alexis Crow, thanks so much for that. Still to come, JSW Steel CFO will be joining us to discuss the company's fourth-quarter earnings report and the outlook for the steel sector. Keep it here with us. This is Bloomberg. Welcome back to Inside. India's industrial output probably eased year-on-year in April, following 3% growth in March. The numbers out later today are set to reflect the additional 10% U.S. tariff and lingering uncertainty about a 90-day pause on President Trump's 26% levy. Let's zero in on the steel sector now as India's trade negotiations with Washington continue. Joining us, Swayam Saurabh, CFO at JSW Steel, India's largest steel maker. Good to have you with us. Swayam, your thoughts on what can be expected from those trade negotiations. What do you hope to see?
Glad to be here, Haslinda. We are positive. What we see is we believe it's all settling down. Gradually, we see more trade negotiations, coming to a point where it is more palatable. We are hopeful that they will all settle and we go back to normal way of business.
Well, the thing is, even if things go back to normal, as you say it, the steel sector, steel in particular, has been front and center in the tensions with the U.S. How might this play out? How are you hedging?
So JSW Steel do not have a direct export exposure to US. So from that perspective, we are relatively immune. But what could happen if these trade negotiations do not settle is what US imports. US imports about 20-odd million ton of steel, which is primarily from the neighboring countries, Mexico, Canada, etc. But also there are indirect exports which originate from Asia. So if those exports do not find landing in US, that could be an exposure for us as a country. But with safeguard duty, we remain relatively confident. We also see the import numbers into India, which has reduced. So we remain confident, but it is something we are watching very closely.
And in terms of the steel supply chains, how might that play out?
So, if I could just talk about JSW Steel or most Indian manufacturers, I think the capacity which we have in India is predominantly domestic. Last quarter, for example, if you look at our numbers, only 8% of what we sold was exported. So from that perspective, we are not unduly worried. Only thing which I just mentioned, 2 minutes back was if trade flow starts to reshape, and there is a steel which do not find a market, which it traditionally has, for example, in US, then these flows could be a risk to India because we are growing in double digit. And that's the only thing we are watching. We are optimistic that with safeguard duty, this remains a relatively safe place, but it needs to be cautiously watched nonetheless.
Swayam, given the uncertain environment, how optimistic are you about better numbers in the coming quarters? Some people were disappointed with the numbers out of the last quarter. Revenues, profit were under a lot of pressure.
We are very positive going into this quarter. And, the drivers are, number one, the volumes. The demand growth in India has held very well for last, this is like double-digit growth for 4th year in a row. Going into this year, we also expect government spending on capex to continue. We expect some revival in private capex. Also, this is likely be a year where monsoons will be good. You would see more rural demand. All of this, gives us confidence that this year, from a volume perspective, will be much better than what it was last year. When it comes to margin, there are some, headwinds, positive headwinds on cost. We saw on a full year basis, coking coal prices dropping by $49 in Q4, which is Jan to March. Coking coal prices came down by $15. We have guided market that in Q1, it will come down by 10 to 15. So this together with efficiency and also the fact that JVML, which was our 5 million ton capacity, which we commissioned last year, will come, fully on stream, and that would also bring our costs down. So we are positive about margin enhancement as we go into this year.
When it comes to volume growth, what kind of growth are you anticipating and what will drive that?
So as I mentioned, our focus is India. And, last year, India added about 15 million ton of new demand by growing at about 11.5%. We expect 12 to 15 million ton of new demand would come this year as well, on the back of government spending, private capex, etc. And we think that's where we have right to play, right to participate. And the 4 million, 10% odd extra volume which we will do this year will predominantly be India. We remain very confident and positive about India.
China's steel exports do have a bearing. In fact, last year it was among the highest. What assumptions are you making about China's steel exports?
So you're right. China exported almost 120 million ton of steel last year, which was 95 the year before and 65 the year before that. So it has almost doubled in 2 years. We also saw China exporting in Q4, which is Jan to March, about 30 million ton, which gives them again a run rate of 120 million a year. So this is something we've been watching very closely. It did affect price sentiments, during the last year. But what happened is in April, India levied a safeguard duty. And that is a very positive news. We saw prices in India moving up in March, then in April. And although it is for 200 days, but we remain confident that it's a very positive measure to protect domestic industry.
Isn't it true, though, that with U.S. tariffs, you just might see more Chinese steel getting dumped in Indian markets?
That's a risk which has existed for 2 years now. And something we are watching very closely. But we also believe that the safeguard duty creates some sort of fair price, fair play environment. And we think that we will be very competitive, in this environment. So we remain confident. But again, this is something which is not in our control, how much China exports out. So we are watching it closely, but we remain more confident than we were last quarter, for example.
Swayam, let's talk about M&As. Currently, the Mozambique deal worth about $74 million has been given the go-ahead. What's changed? What's allowed for this deal to go through?
So, the mining lease, the acquisition which we did was a rightful one. And I think Mozambique went through, policy changes. But today, we are very confident that now the Council of Ministers has approved the lease transfer, which will allow this deal to get closed. And in, over coming few quarters, we will have new coal coming in from this asset.
How much more? How significant is this deal when it comes to your production?
On full capacity, it's going to be quite significant. It will be about, in first phase, so 2.5 million ton. But this ramp up would take time. What we have also communicated that we want to have about 50% of our total coal captive, and that would include assets which are in India and also outside India. So from that perspective, Mozambique coal becomes an integral part of our strategy.
We know that you have a 2031 expansion target. Where are you with that, especially on the back of the unsuccessful attempt with Bhushan Power?
Well, it's not unsuccessful yet. There is a Supreme Court adverse order. And, I do want to say that we have implemented the resolution plan in full compliance with law. We have turned around this asset to the state where it is today. And we are closely, working with our legal team and advisors to take the remedies which are available to us. So it's not gone yet, but this is all I want to say on BPSL. Coming to the 50 million ton plan which we have announced today, with BPSL, we have 34.2 million ton capacity in India, 35.7 globally. And we have announced 2 expansion. One is in Dolvi, phase 3, taking it to 10 to 15 million, as well as in Vijayanagar, where we are going to do a blast furnace upgrade, which will add 2 million. So that would take us to about 43.5 by FY27. And from 43.5 to 50 plan is largely brownfield, significantly low cost of capex per ton. And that's also mapped out. So we'll announce that in future. We stay pretty much on track to get to 50 million by FY31.
What kind of acquisitions might interest you in the next 12 to 24 months?
The opportunities are far and few now because steel as an industry in India has gone through consolidation in the last 20 years. There are some PSU assets. When they come on block, we'll evaluate, but we are not really looking at inorganic way of acquiring capacity at this stage.
As you look towards your expansion in the next several years, amidst a pretty challenging environment, what's foremost in your mind? What are the key factors you're taking into account?
More than anything else, it sort of proved to us that our cost levels has structurally come down because, we were under pressure. Entire steel as a sector was under pressure because of overcapacity in China. That also gives us confidence that, once the price environment starts to get better, which is what we see now, our margins rapidly will expand and that will be reflected in our results. So we remain actually positive. I mean, last year proved to us that we can still be fairly competitive even in a stressed price environment.
Swayam, thank you so much for your thoughts today. Swayam Saurabh, CFO at JSW Steel. Well, India's been trading for about 10 minutes now. Let's do a check on the initial numbers. The benchmarks we have in the country, of course, we've had Asia under a lot of pressure. It does seem like Asian benchmarks also under pressure right now. Sensex currently down by about 1%. In terms of the Indian rupee, it is currently down by 0.3%, even though it has been a weaker dollar environment. In terms of the broader Asian FX space, let's take a look at how Asian currencies are doing on the back of that weaker dollar, down for a third day in a row. The yen currently trading up by 0.3% versus the USD, and the Chinese yuan currently trading lower by 0.1%. Before we go, here's a look at tomorrow's program. Federated Hermes joins us to talk fixed income investment strategy. Plus, we'll be live at the UBS Asian Investment Conference in Hong Kong, speaking exclusively to their India markets head. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.